So I've had hundreds of people come to me and say, Brant, I've got money on the sideline. I'm going to watch all your YouTube videos, but bottom line up front, what should I invest my money in? The answer to that is an ETF, or exchange traded fund, specifically one that tracks all publicly traded companies in the United States. An example of this, something I put my money into, is VTI, sold by Vanguard. It's the Vanguard Total Stock Market Index. So in this video I'll explain what an ETF is, what the difference between an ETF and a mutual fund is, and then the so what of that. So why does that matter, and what kind of return can you expect to see after investing in a total stock market ETF? So an ETF is an exchange traded fund, which means that it's bought and sold just like a stock is on the stock market. It differs from stocks in that generally ETFs track a specific market or index, whether it's the entire United States stock market, just the tech sector in the US, perhaps only a foreign market, the list goes on. And ETFs can hold any type of asset, not just stocks. So you could buy any type of ETF, whether it's one made up of small cap bonds to small companies, or it's stock only in the tech sector in the United States. But no matter what type of ETF you purchase, you're not just purchasing one asset. You're purchasing small portions of many assets. So if we're looking at a total stock market ETF, you're going to own 1/100th of a share of Amazon. You'll also own 100th of a share of Delta and Apple and ExxonMobil and many other companies. So you might be asking yourself, what's the difference between an ETF and a mutual fund? So mutual funds are professionally managed investment funds containing stocks that the fund managers deem worthy of purchasing. You pay a higher fee for the manager to actively add and remove stocks from that fund. An ETF, however, is established in its beginning to carry a certain number of stocks that do not actively change. So what does that mean? Or what are the benefits of an ETF versus a mutual fund? ETFs have lower expense ratios than mutual funds because no one is actively managing the ETF. Your expense ratio for an ETF is going to be 0.05% versus the expense ratio for a mutual fund is 0.5%. That's a 10 times higher expense ratio for the mutual fund over an ETF. If we apply this to a $1,000 investment, you'll only pay 50 cents for the expense ratio on the ETF, whereas you would pay $5 for a mutual fund. Another significant difference between the mutual fund and the ETF is that a mutual fund can only be purchased at the end of the trading day, and you're going to pay the same price as everyone else who bought or sold that day, regardless of what time you place the order. Unlike an ETF, where the price fluctuates throughout the day and you can buy or sell that ETF throughout the day. Ultimately, what this means is that ETFs provide you more control over the actual price you can buy and sell at. And finally, ETFs don't have a minimum initial investment requirement. Unlike mutual funds, which require various initial investments that range from $3,000 to $10,000 or even more. So all in all, the best place to put your money is into an ETF that tracks every single publicly traded company within the United States, such as VTI. This type of ETF is automatically going to diversify your portfolio, protecting you from picking the wrong stock. And you can expect an average rate of return of about 7.5%. And to show you the power of VTI, if you had invested $10,000 in it in 2010, it would be worth $40,000 today. So if you're unsure of what to do with your money, I highly recommend you put it into VTI through Vanguard, and I'll talk about specifically how to do these investments online by sharing my screen and talking through exactly how to do it in my next video. If you enjoyed this video, please like and subscribe and check out my other videos.